Okay, I want to be honest with you. If you're watching this video, you're watching the show, the one thing that I believe everybody, regardless of what you do for a living, what your goals are in life, how much money you make, any of that, the one thing that we should all be doing and taking advantage of when it comes to the stock market is using the IRA so that we can one day pull out that money from compounding those efforts over the years, tax-free, and use that money to benefit the future generations of our family. That is a gift from the government to you, one that pays dividends wildly if you use it correctly. But most people have never been taught how to use an IRA correctly. So what I want to do is today give you what I believe is the only strategy that you ever really need to use an IRA to get its full potential and to garner, listen closely now, 60 to 100% a year returns. Unbelievable, I know, but it is doable because I've seen it done and I've done it. Let's get into an IRA trading strategy.
The views and opinions expressed on the Rob Review do not represent the views and opinions of WIG TV or any associates. The tactics given within are tactics that work for Robbie only, and your results may not be duplicated the same as the circumstances may be different. Your use of the Rob Review content to better your own life must be taken at your own risk. Understand that I recommend everyone consult their own financial professional before moving forward.
Now notice I said trading strategy in an IRA. I did not say investing or anything about how to invest in an IRA, because that's the meaningful, serious difference here in what I've been taught to do and what I believe the majority of the world of finance teaches about how to use an IRA. And I'll get into why in just a second. First, welcome back. Thank you for tuning in to the Rob Review for all these years now. For those that have been religiously enjoying this programming and have told me so, and you're the reason that I continue. And as I build out a bigger audience with this, my only hope and my only goal is to shatter those beliefs that are incorrect about financial things that you can do in the stock market, to destroy those myths that you have to have some kind of a correct education in order to be able to really benefit from the stock market, from what it has to offer, that you have to have a lot of money to invest, or that you even have to have somebody to help you do it, to hold your hand. All those things are really incorrect. It doesn't mean that you shouldn't utilize those. It doesn't mean that there's strategies and benefits to having a financial advisor, a financial analyst on your team. It doesn't mean that everybody should do it on their own, but it does mean that those myths out there need to be busted, and that's what the Rob Review is here to do, is to bust them. So I'm your friend in success. I'm Robert Morris, for those of you that we haven't met before. Welcome to the program. Let's talk about the difference in how I look at an IRA and how most people are taught. See, IRAs were created by the U.S. government to basically promote the investment of our dollars as retail investors into the stock market. That's what IRAs were mainly created for, to give people the want to and the incentive to invest in the stock market to help it grow, and to allow everybody at that time that worked for great manufacturing companies to want to invest their own dollars and own a piece of the company. And in order to do that, to be able to get benefits long term and have their own retirement from that. Now, 401ks are a part of that too, but IRAs are more self-directed. There's so many more things you can do with them. 401ks are a very limited way to invest. And if you have that, then you got to use it, and you should use it in a way where it's traded rather than invested. And that's the difference, right? See, when IRAs came about, people jumped at the chance to sell them as investment vehicles. However, the people that sold them had never used them as investment vehicles. And they do not and have not done enough standard practice and understanding to realize that the investing in an IRA, though beneficial, is limiting. IRAs, when traded as trading vehicles, the compounding is greatly increased, right? And that's the benefit, right? Because the tax deferred of those gains allows you to compound them at a greater return. If every one of my trades outside an IRA, I give a third of it back to the tax man. Inside an IRA, I don't do that. Man, the compounding is astounding. Trust me. And when you take that and you then apply the fact that you can do it with 60 to 100% returns a year, it sounds too good to be true, but it's doable. However, it's riskier. See, that is what you have to take away from this, is that if you want to get more out of your money, you have to be willing to take more risk. But I believe that risk is greatly mitigated by education, understanding, practice, and mentality. Bottom line is, I don't see risk the same way as I used to. And I can talk to people that do, and I can tell the great difference. Money is a tool for me, and that's all it ever will be, and that's all it ever is. It flows out from me to somebody else and then flows back to me, and that's the way it works. And I want it to be used. And so, but my risk in the IRA is mitigated. And see, so first of all, we have to divide that. We have to say we're not going to invest our IRA. We want to step aside from the 10% a year gains, which are just ridiculously puny. And we want to step into trading it, but only trading it specifically at specific times of the year. And so these are times of the year when the stock market moves in great strides, usually all within the trend of the year, which is either up or down, right? And so you can use this strategy following the trend of a year to mitigate your risk by only trading your IRA maybe 6 to a maximum of 10 to 12 times a year. I have never done more than 8 trades in my IRA in a year, which to most people is crazy, right? 8 trades is so, but it's focused, and I only do it around certain times of the year. Here's the times. I only trade this IRA first plant around about February, mid-February-ish, early February to mid-February. That's the first time, right? And then mid-March through April, second. And then there's a greater time of the year for those moves when you get into August, September, and then October, November. And those are generally the best times to look at focused trading. Now, it doesn't mean you just trade them blindly. It means you look at those times of the year to concentrate your effort. And now, if you're looking at those times of the year, why? What do you trade? Well, of course, you've got earnings. And a lot of people see that as a scary time of the market, right? Because you don't know how a stock is going to report earnings. Well, it can be scary, sure, but generally speaking, stocks have momentum going into and out of earnings. There's about a 3-week window before and after an earnings release on a stock when you can get a great catalyst move, not dependent upon you knowing how the stock is going to report earnings, just the win, because you want to be out before the earnings date, because earnings is a crapshoot. However, a better strategy than even trading stocks at all is trading indexes, trading the market moves around those times of the year. And if you have a small account, like I did when I started my IRA, $1,000, $2,000, the best way to start, I believe, is with small indexes like the QQQs and the SPY spiders. So ticker, QQQ, ticker, SPY. Those also mitigate your risk because they move with the market. So the Qs moves with the NASDAQ. The spiders moves with the S&P 500 index. Both do not move at the same time, but both give you potential during those times of the year we talked about to extend your trades to a place of high profitability when trading options. What kind of options do you trade with the indexes? I would trade out of the money options, and I would trade during those times of the year long 1 month, 2 month, 3 month out in time options to give you the best chance of high profitability. As you grow your account using those QQQs and SPY indexes. You're going to get to a place where your account has minimum 5 figures, 6 figures in it, somewhere in there. And you're going to start to see that there are things that move better than those small indexes. And you have your main markets that you want to follow. The Dow, the NASDAQ, the S&P, and the Wilshire. Those are the 4 main markets, right? You got your $ INDU, $ COMPQ, and $ S&P, or SP500, and $ W5000. Those indexes move with those markets. And there are indexes that move specifically with those markets in the form of the NASDAQ has $NDX. The Dow has indexes that move with it. The S&P 500 has $SPX and $OEX. And the Wilshire has $RUT, the Russell 2000. Those indexes are expensive to trade, but once you build up your account to a point where you're used to the trades and you've seen the gains, and now you've got 15, 20, all the way up to however much in your account because you've done it for a few years, maybe less, depending on your compounding, you can see now where it's more beneficial to just trade the market indexes because they move. Man, they move. I mean, I'm not talking about just 60% anymore, guys. I'm talking about I've had trades with the NDX where they're like 300 or 400% on the regular because they move so quick, so fast in either direction. $NDX, $SPX, $OEX, $RUT. If you look at and focus your trading around those 4, focusing on 6 to 12 a year around those main times of the year that we talked about, and we're just going to focus on trading those. Now here's where the beauty of the money comes in. Once you get used to the momentum of doing this, you can very, very simply, not easily but with work, get to the point where you can compound your money in each trade by taking the profits and the proceeds from each trade and putting it back into the next one. So let's say you start with 15 grand after you've built up your account over time, and you're ready to start trading the big boy indexes, is what I call them. And you're going to see where like the OEX, for instance, is going to cost you $25 in an ask to get in. But that's okay. You got the money. So you put all 15 into a trade. You get 100% back out. Now you're putting in 30 into the next trade. You get 100% back out. Now you're putting in 60 into the next trade. You get 100% back out. Now you're putting in 120 in the next trade. By the end of the year, you're going to have a lot of money. You may not be able to get through the whole year without getting to a point of sick to your stomach, I can't put this much into a trade. So at that point, you reel it back and you find yourself an X amount that you're comfortable with and you start back over. And so now that you understand how the compounding can happen, how do you mitigate that downside risk? Well, what I find is that you do the opposite side of the trade on the naked. And of course, you don't trade naked, but you trade on the naked option. So if you're doing a call, you trade the naked put. If you're doing a put, you trade the naked call. Those downside moves or those trades that move against you, a lot of times the losses will be mitigated or completely taken out to a break-even point by the naked side of the position. I've had 50, 60% losses, but if you can then keep your ego in check as a trader, and you can then keep your emotions in check as a trader, and not let fear and greed get the best of you, if you have a losing trade that's going against you, you can cut those losses fast and still keep the gains rolling in the next one.